This episode was recorded before April 1st, 2022, when Danielle Smith announced her candidacy for the United Conservative Party of Alberta.
Welcome to Danielle Smith's Fraser Forum. This program is part of a series of podcasts doing in-depth interviews on free enterprise and personal liberty. I'm your host, Danielle Smith, president of the Alberta Enterprise Group. Go to fraserforum.org where you can subscribe, comment on the program, and see links to the studies we discuss. You will also find archives of previous episodes. Our email address is danielle@fraserforum.org. We'd love to hear from you.
I think one thing that has surprised people over the years is that there really is something that's unique to crowdfunding, which is the wisdom of the crowd. But the reality is that fraud rates in crowdfunding are actually substantially lower than what we'd expect, and even lower relative to the number of fraud cases for publicly traded companies.
Hello again, it's Danielle Smith, president of the Alberta Enterprise Group, and this is another edition of Danielle Smith's Fraser Forum. This week we'll be speaking about entrepreneurship and all of the different means of crowdsourcing funds for entrepreneurs with Douglas Cumming, who is the Santis Distinguished Professor of Finance and Entrepreneurship at Florida Atlantic University and Senior Fellow with the Fraser Institute. Professor, thanks so much for being with us today.
Thanks for the opportunity. It's great to join you.
Now, I know that Jason Clemens will be angry at me if I don't ask you to first define our terms so that we can talk about what an entrepreneur is and what an entrepreneur isn't. I know that there's a view of entrepreneurship that it has to be disruptive. It's not enough to just be a business owner. And I think this notion of creative destruction comes from Joseph Schumpeter. And I just want to make sure that we're kind of talking about the same thing when we talk about entrepreneurs.
For sure. Yeah, there's often a tendency for folks to say that entrepreneurship has something to do with self-employment, but it's not necessarily the case. Many self-employed people aren't really all that entrepreneurial, and you can even be entrepreneurial within a large company as an employee. So entrepreneurship is typically about creating something new, a bit of creative destruction, as you said, and so but it's not really. Sometimes people, for empirical measures, will look at things like self-employment, but it's really about creating something new.
If we were to try to develop some better measures around it, what would we look at? Because one of the things I'm often struck by is when there are periodic articles saying all of these huge companies that existed in the 1960s, none of them exist today, or very few of them exist today. So that's sort of a after the fact recognition that there's obviously been something that's happened in the meantime. But are there better measures for how we can determine how entrepreneurial a society is?
Yeah, it's a bit tricky. Some academics have tried to do this over the years, and they developed a group called the Global Entrepreneurship Monitor, or GEM is the acronym, and they do it based on survey questions, asking a bunch of surveys. Have you been thinking of starting a business, or exactly how innovative your activities are? Those sort of survey questions to get around, not using self-employment as a measure of entrepreneurship, and they've had, I think, some degree of success, but anytime you start basing things on surveys, few people shrug their shoulders, and so but indeed a tricky thing to measure. Same thing with measuring innovation. There's a tendency that we want to count patents and patent citations, patents for the number of innovations and citations for the quality of innovations, but many firms create new things without patenting them. There's even in computer science, there's open code software, which is the antithesis of patents. And so measuring innovation, that too is equally challenging. So we're in an evolving state, I think. And the person that comes up with good measures is going to become quite famous.
Well, we'll probably end up talking about some proxies, because I wonder if the measures you look at are maybe some of the best indicators of entrepreneurship. But I almost feel like I need you to make the case for why creative destruction and entrepreneurship is something that we should value, because it seems like there's this constant tension in economies and with political leaders that once a company becomes, what's the term, too big to fail, then that's when they can start doing the rent seeking in order to keep their competitors out. And yet we all like innovation. We all love the latest new gadget and the newest technology. So it seems like we have a double-mindedness about it.
Yeah. Well, without innovation and entrepreneurship, the modern economies are not going to do well in the 21st century. So to keep things moving forward, uh, indeed, there's even an expression and a book with the title "Saving Capitalism from the Capitalists." So that if your company's risen to the top, you don't want to engineer a set of rules that allow yourself to have a monopoly or oligopoly and keep everything else at the bottom and make sure that others have trouble. So that's the approach that folks like. You want new ideas, innovation, entrepreneurship, encourage people to start new firms if they have a good business model, a good business idea. And without those innovations, businesses could be disrupted by people in other countries. And so that's really the engine of economic growth and prosperity. Innovative countries are going to succeed. The ones that don't innovate and support entrepreneurship and innovation are going to be in trouble.
Is there a good measure? Who would you say is kind of near the top of the list when it comes to embracing this notion of what entrepreneurship brings?
Which place around the world? Is that what you
Yeah.
mean?
Well, yeah, because I look at Economic Freedom of the World Index, which isn't the
Yeah.
best proxy, really, because it always has Hong Kong and Singapore at the top of the list. And there's been quite a bit of disruption in the world when it comes
Yeah.
to looking at whether those are truly free jurisdictions. And so
Right.
freedom isn't and entrepreneurship support aren't necessarily the same thing.
No, they're you can have entrepreneurship in relatively, I don't want to say oppressed, but very restrictive societies like, for example, China and Hong Kong, as Hong Kong becomes increasingly integrated with China. And then same thing with Singapore, some very restrictive rules, but at the same time, having a very stable legal system and certain legality with their transactions and enforcing things, so that on some levels it does enable entrepreneurial activity, but on others, many folks in North America would consider it quite stifling. But within the innovation entrepreneurship sphere, for the longest time, folks have looked to great models such as Silicon Valley. It's not the best for everybody, I know. So I'm Canadian. I spent most of my life living in Canada, and many venture capitalists and entrepreneurs talk about problems associated with starting a business in Silicon Valley in terms of competing for employees, employee loyalty, expenses, and running a business there, the competition for talent, and it's not necessarily, a good fit for everybody. But that's, but there, one thing for sure in that environment is that the access to capital is perhaps greater than what you see in other contexts. Then in terms of nationwide, if you're to pick a good nation that has an excellent startup environment, would probably the world's number one for many years, people have considered to be Israel. So they have excellent education system, extremely high tech businesses, very successful businesses, capital for entrepreneurs, including crowdfunding, but not limited to crowdfunding. And so there are even books called Startup Nation, and that's all about Israel. So that's perhaps one of the greater success models around the world.
Excellent. Well, we'll talk a bit more about what makes both of those regions successful. But before we get too deeply into this, when I start thinking about entrepreneurship today, I can't help but think it's almost exclusively the realm of technology companies. That when we talk about angel investing and venture capital, it seems like it is the technology model. And maybe that's just the period that we're going through right now, where we're just having such an incredible boom as we're talking about the Internet of Things and different products communicating to each other and 5G. But when we're talking, should we confine our discussion to the technology realm, or is there a broader way to be thinking about entrepreneurship?
Well, I don't think you don't need to make that restriction at the outset to say it's all about technology. But the reality is that most everything in the entrepreneurship and innovation space is about technology. But there's no need to sort of definitionally to make it about that, because there's the odd business that creates something new without being overly high tech. So you don't need to. I think cut some folks off just by virtue of the product or service that they're trying to create.
Okay. Just so, and we may find examples that are non-technology, but I think that
Yeah.
probably most of the examples that we'll be talking about in the next hour or so are likely to be in the tech space. So
Absolutely.
I just wanted to make sure that people knew that's where we're going. So
Yeah.
let's then talk a little bit about how important it is. We talked about the regulatory environment as being one that allows for the attraction of and support of new entries. So that's important. But how important is capital, being able to finance an enterprise and having the kind of regulatory environment that makes capital raising easier? How important is that in supporting entrepreneurship and innovation?
Yeah, well, it's everything really. If you don't have money to develop your product, then the idea isn't going to get off the ground. You don't want to be only financing those people that are lucky by birth to have, an endowment funds that allow them to get ahead. So having external capital is critical for enabling the average person that has an idea and some risk-taking abilities and incentives to do something new to get ahead. And so without the access to capital, then entrepreneurship can't flourish at all. So that's one of the necessary components. It's not sufficient, but it's certainly necessary to enable entrepreneurship.
And how easy is it to access capital? Because I guess there's two major approaches that you can take. I hear a lot in the investment community that I was just recently introduced to in Alberta called Startup TNT. They talk a lot about bootstrapping, and I don't know what the technical definition of that is, but it sounds to me like you kind of do it yourself. Friends, family, mortgage your own house. That seems to me to be the most common way of a startup at least getting into the market. Is that the reality that if you're going to be an entrepreneur, you've got to put a lot of your own skin in the game?
Absolutely. You do need to put your own skin in the game. The expression bootstrapping, by the way, came from the idea that, if you think of wearing boots with straps, and you're lying on the ground and you're literally pulling yourself up from your own bootstraps. So that's, which is sort of impossible. You can't pull yourself up by your own bootstraps. So that's how that expression came to be, bootstrapping. And when you're entrepreneur starting up, if you don't put in your own skin in the game, then the external investors aren't going to see, why they should get involved, by taking a bet on a relatively younger company where the entrepreneur isn't fully committed by, going head first into battle, so to speak, with their own resources behind them. So, the way we think about it is costly signals. So, it's because it's hard for folks to convey their ability to external financiers. And so entrepreneurs that are successful have ways of signaling to those investors something about their quality that other folks have not the ability to replicate or to make a false signal. So developing some kind of new idea, perhaps comes alongside getting an award, a grant, winning a show or winning something on TNT or getting far ahead in that kind of show. Something that distinguishes them from someone else as a way to get access to capital. Yeah.
Let's then talk about going to the bank, because I think for most people who are not entrepreneurs, the experience with the bank is you go out and you buy a home and you're able to get a mortgage for a long period of time at a very low interest rate. And then if you decide that you want to go into business, holy Dinah, it is not the same terms, not even close. I just recently got a business loan. And so you can get a long-term mortgage on your house for 1 or 2 or 3%, but to get a business loan, it's more like 8 or 9 or 10%. And so I don't understand why there's such a huge difference. It's actually sort of surprising to me. You would think that somebody who's wanting to create a business with revenue and employ people, you would think that would get more favorable financing terms from the bank. And yet it's not the case.
Yeah, the incentives of the bank managers are certainly different than what would be needed in many cases for entrepreneurs. And think about how folks at a bank are compensated and what their incentives are. So the incentives are to minimize the loan loss ratio. So there's no incentive on the upside. It's all about minimizing the downside. And so banks make loans, and you want to make sure that the entrepreneur pays those loans back. And so they have very strict ratios that they look at in terms of income relative to things like assets, how much money is being borrowed, what kind of collateral can be put up, all these sort of strict financial metrics that they have a huge amount of data with that they show are correlated and related to minimizing the loan loss ratio. It's not about creating anything on the upside. So you just introduced this topic by saying, well, entrepreneurship, what is that about? Creating something new, generating huge things on the upside. And the bank's incentives are everything about minimizing the downside. And so entrepreneurship and bank loans, certainly many entrepreneurs have some bank loans, but that's, many entrepreneurs can't get off the ground because they won't be qualified for getting a bank loan, because if the brand new idea with minimal collateral, they need, capital to get their idea off the ground. It's not going to fit for what's needed to indeed get a bank loan.
It's remarkable, actually, because I often look at that and think, well, if it should be binary, it's either, yeah, we'll invest in you or not. It seems strange that the rate would be higher, because then you're making it even more difficult for the entrepreneur to pay it back because they've got a higher interest charge. It seems counterintuitive that you would make it even more difficult.
Well, although in finance, we have this strict notion that higher risk, you need a higher return. So the bank's going to be thinking about it as, well, there's a higher chance they don't pay us back, so we want a higher interest rate. So that, I think that's where they're thinking. But indeed, there's a Nobel Prize winner, Joseph Stiglitz, had shown, dating back to 1981, that Joseph Stiglitz, by the way, ran the World Bank for a few years and everything, wrote these books, Globalization and Its Discontent. So very famous guy, and his Nobel Prize winning idea was that you increase the interest rates, you increase what's known as an adverse selection problem, meaning that your higher interest rates are associated with attracting the riskier borrowers that indeed have a higher chance of failing to pay you back. So you're, by having the interest rates higher, you're getting the borrowers, you're more likely to get the borrowers that you don't want to actually borrow money from you. So that's what they mean by adverse selection.
Let me pose another hypothesis to you, and you can tell me if there's any support for it in the economic literature too, because I've been struck by places like Grameen Bank and some of the work of Hernando de Soto doing microcredit loans, and the repayment rate is quite remarkable. I think in the order of 98%. And so in some ways, it's got me wondering whether we create a bit of a self-fulfilling prophecy or self-fulfilling reality when it comes to business failure. If we starve it out of capital, well, of course it's going to fail, especially if you need the capital at a pretty crucial time. So, and then you have stats that show that businesses fail. So are we caught in a bit of a hamster wheel?
Fair point. The Grameen Bank and microcredit is a whole new area. But one thing that I would say about that element is that folks that are involved in the successful models there, people that in those contexts take huge pride in paying back the amounts that are borrowed, or however the financing arrangements are determined. And they would rather lose an arm than not show good faith in paying back as part of their community and other things. So done properly, that type of capital access around the world and in the developing world can do tremendous good. And but it's very much depending on the context and how that's put forward, and it's also understanding the local conditions and the incentives of the people that you're lending money to, or whatever the particular financing arrangement is.
Well, that's interesting. Well, let's then talk about crowdfunding. And I know there's different types to it, but I wonder, do you see evidence of that same kind of desire to to pay the money back that happens from crowdfunding? Does it have that same kind of community imperative that I don't want to embarrass myself? Is there any evidence that that's the case?
Yeah, certainly. I think one thing that has surprised people over the years is that there really is something that's unique to crowdfunding, which is the wisdom of the crowd. And so, so thinking about general things about equity crowdfunding and regulations and our concerns with this marketplace is that we are worried that perhaps there might be a great amount of fraud in this marketplace. That, for example, my former law school securities law professor in Toronto had quipped once about, if you mention crowdfunding to a securities lawyer, you better get a defibrillator because they're going to have a heart attack because there's no prospectus level of disclosure as we have with an initial public offering. And so, but the reality is that fraud rates in crowdfunding are actually substantially lower than what we'd expect, and even lower relative to the number of fraud cases for publicly traded companies. We did a look at this a few years back, and if you look at frauds per listed company, say on NYSE or the New York Stock Exchange or on NASDAQ, it's around on NYSE it was about 2.5% of listed companies per year. There's some sort of issue involving the SEC and the detected fraud. And then on NASDAQ, it's a little bit higher. Listing standards are a bit lower there, so perhaps correlated with listing standards, about 4.5% of companies per year. And then you think, well, with crowdfunding for the number of campaigns that go out, is the fraud rate higher than 4.5% per year? Absolutely not. It's like way below 1%, way below, like 0.0001%. So the detected frauds are very low.
What's the theory behind that? What do you think is happening there?
Well, there's a lot of eyes on the projects. So to give a famous example, 'cause I like this example because I really like Kobe beef. I don't know if you've had Kobe beef, but there was.
I've not, but it's a very premium beef product. Don't they feed it?
Well,
don't they give it massage to the animals and feed it beer and all of
exactly, that? Yeah. You want to. That'd be a good life to be the cow that is massaged and given beer your whole life. But although with an unhappy ending, I suppose. But so the idea with the entrepreneur that the entrepreneurs had is that, you go to the gas stations, or that's typically where I've seen this product. You get something called beef jerky. It's like a stick of meat in a package. And if you've ever had it, at least it's not for me. I don't like the taste, although I like beef. And so the idea was that they would put Kobe beef into the beef jerky. And so that was their funding idea. It was a Kickstarter, so rewards-based crowdfunding campaign. And they were claiming to put Kobe beef in their beef jerky. But then by the wisdom of the crowd, so the campaign, that particular one, they only wanted to raise a few $1,000s to get over their reward. So on Kickstarter, the way it's set out is that you state what your goal is. And if you don't get over that capital goal, then Kickstarter will not transfer the money to the entrepreneurs. So it's called it's called an all or nothing. So if you don't meet your campaign goal, you don't get the money. That's how Kickstarter works. And so they set a fairly low campaign goal of a few $1,000s, but Kobe beef and beef jerky is a good idea. So they managed to get over $120,000. But the campaign hadn't ended yet. And people in the crowd started asking a few questions like, boy, they sure seem to be claiming to sell a lot of Kobe beef, so the amounts that they were claiming, some people worried that it was, more than the worldwide supply of Kobe beef. That's one issue. Another issue is they were offering rewards in exchange for the donations, rewards-based crowdfunding. And the cost of the rewards seemed overly high relative to the actual amount of money being brought in. So these things just didn't seem to add up. And so complaints were sent into Kickstarter that people thought that this must be a fraud, and Kickstarter indeed suspended the campaign before they had to transfer the 120,000 over. Then in a paper, we just published this paper earlier this year in a journal called the Journal of Business Ethics, where we went through about half a dozen countries, got all of the fraud cases, like the Kobe beef case, but a number of other ones, and found, only a few hundred frauds relative to, hundreds and hundreds of thousands of campaigns. And
Remarkable.
so
So,
that fraction of fraud cases is very small.
well, and it's interesting that you found that one case as an example of a fraud that wasn't successful. So they were making
Yeah,
a lot of
yeah,
promises they couldn't deliver on, and the crowd found it. Are
yeah.
there other examples where ones get missed?
Yeah, sometimes in some cases, money has been transferred over to the entrepreneurs. Uh, the in these reward-based campaigns in the particular country, it would go to under the gamut of the Consumer Protection Act. That's how it would be enforced. If it was an equity or debt campaign, then it would fall within the purview of securities regulatory authorities. But the number of these frauds is in fact really quite low. But yeah, much lower than what we see in the area of publicly traded companies. Having said that, we need to be a little bit careful, because there's a fine line between a fraud and a mistake or inability. So for example, in the area of rewards-based crowdfunding, a common one is that you see online is that someone has a new and better drone, and they're coming up with an idea of a new and better drone, and then they in fact don't actually come through and successfully develop the project. And so there are a number of these failure cases. Is it in fact a fraud? Well, we have ways of looking at that. So for example, if the entrepreneur takes the money and doesn't communicate with the crowd, explain why the project failed or anything at all, they just take the money and disappear, then that's much more likely to be a case of fraud as opposed to mistake or inability or whatever other sort of reason for failure. But so indeed, we do have failure in entrepreneurship.
It's almost a given that you have to have failure, it seems, to ultimately succeed. There's so many entrepreneurs who have stories of failure after failure, and then they finally find the one thing that works. Or in the case of Thomas Edison, found 10,000 things that didn't work, I guess, before he found the one thing that did. Are you able to quantify the failure rate? You quantified the fraud rate, but are you able to quantify failure rate in this kind of funding?
Yeah, non-delivery, say in rewards-based crowdfunding, non-delivery rates are fairly high. I don't have those figures at the top of my head, but I would expect somewhere around a third of projects are perhaps not successfully developed and delivered. But I'm biting my tongue a little bit because I don't have those precise numbers on my fingertips. I haven't looked that up recently. But but indeed, yeah, non-delivery, it can happen.
Is there some sense of whether or not it's larger in this area than in traditional type of financing?
Well, you think of, say, venture capital investment. So venture capital is a little bit later stage, typically, not always, but typically. Venture capital investments are normally in the $1 to $10 million range in the initial stages, where and then as it evolves into later stages before it becomes a public offering, for instance, they could get into the tens of millions or hundreds of millions. In some cases, the valuations go into the billions. But so in those projects, you see, give or take, a third companies are written off in a venture capital portfolio. So that's quite similar, and that's what you do expect in high risk entrepreneurship. And so for a venture capitalist, say if you think of 10 investments that they made, they're hoping for a home run from one or two of them. A third of them go bankrupt, and you have some mediocre stuff in the middle that nobody's really caring too much about. But most of the returns are made from one or two home runs.
Interesting. Do you know how that compares with established companies? Because it goes back to the point that I raised earlier, is that just because a company is big and established doesn't mean it's going to last forever. Yet we seem to think that because something's made it to the stock market, that it has a higher level of tolerance when it comes to risk, or maybe a lower risk profile. And it's important when we get into talking about why these things are regulated differently. But what does the data show? I mean, once something is arrived on the stock market, does it have a lower risk of failure?
Well, the people love this expression, too big to fail, and that sort of thing. But it's interesting to look a bit historically at the data. So in the U.S., for instance, the number of publicly listed companies peaked around 96. So where there was roughly twice as many publicly traded companies back then in the U.S. as we have now. So so a substantial reduction. Some company failures, some mergers, and the like, and substantially fewer initial public offerings over the last number of years.
Hmm.
And though the decline in IPOs, people have attributed in part to increasing regulatory standards through Sarbanes-Oxley, which put in place some restrictions, for instance, on directors and increasing standards of director liability. So after some scandals like Enron and the like. So if you're a negligent director, that could land you yourself in jail. And then the Dodd-Frank Act changed the economics of going public, so that it made it, you have to be a much bigger company for the economics of going public. So around the late 1990s and early 2000s, you could have IPOs in the U.S. at $100 million valuation, and then nowadays, most companies going public in the U.S. they're raising money in the billion plus range, or at least the valuation of the company is in the billion plus range. If you're not a company that's as the expression is, a unicorn, if you're not a billion plus valuation, then it's almost it's very, very hard to get a public listing in the U.S. for a smaller company than that.
You've just pieced together an important piece for me, because as I mentioned, I've been involved in this group called Startup TNT, which does that really early stage investment. And I think that would be akin to crowdfunding. I think of it as angel investing, but I don't know if I'm going to use the right terms, because the venture capital world, you said, is $1 to $10 million. So I think of angel investing as being below $1 million. Venture capital, $1 to $10 million. There's this something in the middle, I don't know what to call it. And then there's the IPO that you need for $1 billion. But one of the things I keep getting told is that there's a real dearth of being able to attract that in that $50 to $300 million range. And you've just described exactly why that is. And so what happens if you can't source that money in your own domestic market? That's when people go to Silicon Valley, or they go to some a place where they have more opportunity. But it does raise the question about how you solve that funding gap that's been created by regulation.
Yeah, indeed, it is tricky. And so for instance, many venture capitalists in different parts of the world, including but not limited to Canada, will see as an exit route selling to another venture capitalist in Silicon Valley, for instance, that gets them more to that scale up range in the hundreds of millions range. But yeah, depending on the phase of which you're investing in the company. But yeah, the profile and process to becoming a publicly traded company, the runway has become a bit longer, because the big exchanges, you have to be a much more valuable company these days to get a listing.
Okay, let me make sure my terminology is correct, though. What is an angel investor? Am I thinking of it right? Is that sort of up to $1 million worth of funding?
Commonly, yeah. So angel investors are rich individuals. Normally, they've been successful entrepreneurs themselves in the past. And so they offer capital plus advice. Which is great for entrepreneurs. Entrepreneurs very often talk about it's not just about getting the money, it's about getting the right money. So you want the money that comes alongside the advice, the coaching. And so if the successful entrepreneur, brings that coaching element alongside a network of, other strategic investors, mixing you with the right lawyers, the accountants, providing strategic advice, human resource advice, so things like putting in stock option plans for employees and other things to professionalize the firm. So that advice component is really critical, and that's a big part of angel investing. Same thing with the venture capitalists. The good venture capitalists are providing advice, not just the capital. And then the amazing thing is, in this marketplace, like for example, you compare to mutual funds, there's very little performance persistence with mutual fund investing. Performance persistence meaning you look at who is the best mutual fund last year in terms of the returns. That's not a very good predictor of who's going to be the best one this year. It's very hard to consistently do well in mutual fund investing. Whereas in venture capital investing, angel investing, there's tremendous performance persistence from one year to the next. So the best venture capital funds have been top, they call it top quartile, the top 25%. The top quartile funds have been the top quartile funds for ages. So there's not so much movement into and out of the top quartile funds over the years. The best predictor of who's going to be a good investor in coming years is who's been a good investor in past years. Same thing with angel investors.
I feel like we need a new term for the $10 to billion investor. It seems like we've got a good term once you are going
Yeah.
to the IPO stage. But what is it
Yeah.
that
Well, the
really
private,
large?
yeah, we would call it more generally private equity. So private equity is, but unfortunately, private equity is a bit of a catch-all term. So, and then in different countries, people define it differently. But private equity is, as it implies, you're financing a company that's not listed on a stock exchange. But for practical sort of things, we often think of private equity as late stage investing. So it's not financing two people starting a business in a garage. That's more like the venture capital sphere. Whereas private equity doing later stage deals, another expression for that is mezzanine financing, if it's financing just before going public. Private equity funds do turnaround investments. The company hasn't done well. They need someone to come in and break it up, turn it around. Buyout investments, leverage buyouts, late stage deals. That's sort of the private equity side of things. And the private equity funds, big ones like Carlyle Group, for instance, is a big American fund. They tend to be really big, so billions of capital under management. And so then that allows them to scale up in that bigger range. Whether or not, entrepreneur needs that to go through, yeah, not necessarily. Like the venture capital funds, at least bigger American venture capital funds will have, syndication networks amongst themselves to provide enough capital to get to a going public stage. But indeed, we do have way fewer IPOs than what we had
Well,
20
then let me
plus years
ask
ago.
you about that, because what's then the advantage of doing an initial public offering? What's the advantage of going public and being traded on the stock market when it does seem like it comes with a lot of additional oversight, a lot of additional liability, a lot more constraint on the decisions that you make, a lot more concern about what happens with your quarterly profit reports. What would be the advantage today of going public?
Well, it's an age-old question. Why list? What do you need it for? So there's certainly, raising more capital, of course, is the main reason why you'd list. So if you're in need of a capital raise, you're going to raise proceeds in an IPO, raise tons of money through an IPO. So that the need for capital raise, it does provide an exit for the investors that were part of the private funding pre-IPO. So it could be an exit strategy for those that were involved, brings in new capital. Indeed, it does come with a lot more oversight, as you said. So you have, analysts following you all the time. You're focused on quarterly earnings. That could be, that short-termism that it creates could be a bit of an issue. But on the flip side, being public gives you tremendous marketing advantages, brings in regular retail investors. So investors like you and I might feel some sort of kinship with owning stock in a company and supporting the company. Take, for example, Disney. A lot of people seem to like to buy Disney stock if they have kids, for instance. They feel like, well, hey, at least I'm investing in the company where I'm spending all my money, that kind of thing. So there's some sort of, ancillary benefits like that. You're in the news a little more frequently, but you don't want to be a publicly traded company if you're not ready to be a publicly traded company. So if you don't want that public disclosure that's imposed upon you, those sort of issues, that could be problematic. And so, so it is a big trade-off. It's not right for everybody. And some companies are best exited as an acquisition. You find another company to purchase you, and that's the best outcome for the company, given some synergies and the like.
Yeah, I feel like I should disclose that I too do own some Disney stock, since you did put it on the table. But
Yeah,
the way
yeah,
you've
very good.
described it as well is that by having that exit, that then frees up the money for the venture capitalist or the angel investor to go back to the beginning and
Yeah,
start the whole process over again. So it creates a
absolutely.
renewal.
Yeah, yeah. The expression that people have is entrepreneurial spawning. So you do an IPO, and then it spawns, new investment, new entrepreneurs. People see the outcome; they want to become an entrepreneur. So IPOs have a tremendous sort of spillover externality, I guess you would say, that leads to the creation of more new businesses.
The only nervousness I have is, it seems to me that when you talk about bringing in the retail investor with the IPO, if you have fewer companies that make it to that stage and you've got a large number of retail investors, we're all chasing
Yeah.
around after the same stocks. So that would seem to escalate the value that those stocks trade at beyond perhaps what their intrinsic value is. And I'm wondering if we're getting a bit of an imbalance in the market, that the regulations have led to more opportunities being in the private equity markets longer, fewer publicly traded, and now we're seeing massive valuations on these stocks. I don't know if there's a way to quantify what a balanced market would look like, but are we beginning to see signs of concerns if that's the case?
Yeah, certainly. A lot of people have expressed those concerns and indeed the regulations do appear to have made being private more advantageous relative to what it had been in years past. However, there is a flip side to that story, which is, the nature of technology and businesses perhaps have pushed us in a direction where there's a winner take all. So to take for example, I got called on Skype earlier on my cell phone here, which I should have turned off. Think of, do you want to own the second best cell phone? Or think of, Uber. If we have driverless cars in the future, there's probably going to be one winner, right? So which company is going to have the platform that everybody uses? And so it's possible that, the way technologies have evolved is that maybe there are greater economies of scope. That means that a single company is going to win and capture both economies of scale and scope, and that's another explanation as to why things evolve. We don't need the second best social media platform, or we don't need the second best cell phone, or say with even doing these Zoom calls or the like. I'm even using the name of one of the companies just by unfortunate familiarity with it. But that's these things could change the way in which businesses operate. But that's an evolving area, of course.
No kidding. I find it interesting you're still using Skype, because I thought how remarkable it was that Skype wasn't able to take full advantage of the COVID era. It seems like platforms like Zoom really have outmaneuvered. So
that's right.
So I'm glad we walked through that, because it does seem to me, going back to the issue of some of these crowd funding models, is that seems to be a way for retail investors, if you want to call it, to have more access to some of these exciting opportunities if they're not an angel investor or venture capitalist, or have private capital or private equity themselves. And so I want to understand a little bit about the different types, because you've mentioned them, but I think just being a bit more precise about the three different categories that they're in. And then I want to be able to direct someone to sites that they can look at as an example if they're not as familiar with them, because there's just a pile of them. So let's begin by talking about crowdfunding, because crowdfunding isn't necessarily an investment. It almost seems to me like it's a donation. And I think of GoFundMe as being the principal way in which I've seen a number of different crowdfunded campaigns, but I've kind of looked at that as almost being more charitable. But crowdfunding can also happen in the entrepreneurial context too.
Yeah. So Indeed, I think with crowdfunding, it's best to think of 4 categories. So
Okay.
you have the donations base, and indeed GoFundMe is perhaps the most popular. And then the rewards crowdfunding, where you give money in exchange for something. It could be, for example, early access to a product. Uh,
Before we leave that, explain how the rewards function worked in the example you gave early with the Kobe beef jerky. Because you said
right.
that the valuations didn't make sense. Like, were you offered 100 tons of Kobe beef jerky for the rest of your life if you gave a certain amount? What give me an
Right.
idea of how it worked?
Yeah. So they set different levels, and I forget exactly the different categories, but a typical campaign might have 5 to 10 rewards levels,
Hmm.
where, if you give $10, we'll say thank you on the internet, or if you give $20, you get a T-shirt. You give $30, we send some Kobe beef jerky to you, and sort of different levels like this that entice people to give, depending on, how much money they want to provide. And the rewards-based crowdfunding levels do tend to be lower, relative to, say, equity crowdfunding and loan-based crowdfunding. But yeah, that's the rewards-based. So the 2 main rewards-based platforms are Kickstarter and Indiegogo. Those 2 platforms can be accessed by entrepreneurs in most places around the world. We've seen data where people from over 100 countries use those 2 platforms.
Okay,
And
now before we go on to the other ones, I think you've got a pretty famous story about the Oculus that was funded through one of those platforms. Am I correct?
oh yeah, this is a Kickstarter platform. Oculus, it's the 3D gaming, so virtual reality, and funded through crowdfunding. And it predated the equity crowdfunding rules in the US. So at the time Oculus went through, equity crowdfunding was illegal in the US. And so the technology extremely popular, and you can imagine how that attract the interest of younger folks, people in the crowd, so to speak, that were into gaming, and this technology of 3D was something spectacular. If you've tried it, it's quite an
I
impressive
have
thing to
tried it.
do.
My nephew
Yeah,
got it, and it is remarkable that you put it on, and
yeah, it's
it's an immersive
exceptional.
experience.
Yeah, you're in a new world. You didn't think it was possible. You jumped ahead in the future somehow. And so the Oculus was very successful. They raised a few million through rewards-based crowdfunding on Kickstarter. The entrepreneurs were successful developing their product, and then they sold it to Facebook for a couple of billion. And then the people in the crowd were very upset. They said, well, we took the risk. We funded this, and we didn't benefit in the upside. And and then more generally, it led people to wonder, to say, hey, I can, take $5,000 or $10,000 and go to Vegas and bet on the slots. But here we are in, America, where we can't even invest in an entrepreneur. And so they that was one of the big things that pushed things forward, to say, well, I mean, we could do equity crowdfunding in all that sorts of other countries around the world. The countries traditionally seen as less entrepreneurial than us, like New Zealand, Australia, the UK, for example. And why can't we do it here? And so that led to the Jumpstarter Businesses Act, and
Well,
bringing it into the US.
before I get there, I'm wondering if that example makes it more difficult for entrepreneurs to use this rewards-based crowdfunding, because it's quite true. I
Yeah.
mean, it's one thing to say, oh yeah, like I'll give $20 to buy a T-shirt for the kids going door to door if they're going to be raising money, but it's another thing to
Yeah.
feel like you put your money in and you didn't get anything out. So has it kind of closed that avenue for people who want to
You
raise that way,
know,
or not so much?
Well, depends on the product. There could be good reasons to go in the rewards-based crowdfunding route, and indeed, the people in the crowd do still love the idea of early access to a product, and so many successful entrepreneurs have gone that route. A good Canadian example, for instance, is Pebble Watch. Company originally, the entrepreneurs were in around the Waterloo area, and it's one of the more successful Kickstarter campaigns in history. They raised, I believe the number was $10 million. And So it's a very successful product. That example predated the Apple Watch. So the company didn't do so well after Apple Watch came out with their own version of a smartwatch. But the first was this Pebble Watch. And
So just so I'm understanding it, then it's almost like at a certain level you're pre-purchasing the product.
Yeah.
Is that how we
very,
should
very
think
much
about
so.
it?
Yeah. That is a way to think about it. But definitely not all campaigns in rewards-based are pre-purchased products.
Makes sense. Okay.
Yeah, so even the craziest example is an entrepreneur in Ohio. Just because crowdfunding has become so popular, people love talking about it. And by the way, the reason people love talking about it is they think of it as decentralized finance. So people, younger generation these days, they don't like these traditional institutional models where someone, in an intermediary is deciding what becomes successful and what doesn't. Whether that's being TV content, financing entrepreneurs, other things. So this is now decentralized finance. So you open things up to the whole crowd. Even more generally, the expression is DeFi. So DeFi, the world gets to participate in how products are developed by having ongoing discussions with the entrepreneurs through these platforms. You can offer comments, advice, and everything. So people just love the concept. Like crowdfunding is, the way of the future for many people. And then if you, support this, then you're part of this bigger community that makes you feel like, you got non-pecuniary benefits as well. And so an entrepreneur in Ohio thought, well, let's take this to the extreme level. And he put up a project that said, I'm making potato salad. And his campaign goal was $10, right? And it was, of course, a joke, like 100% of a joke. But and he had rewards level that if you give me $1, I'll say your name on the internet. $2, I'll cut your name into a potato. $3, I'll put your name on a recipe book. Just total joke. And he raised $65,000.
Oh my gosh!
Incredible. People say, I got to be part of the potato salad crowdfunding. So these things do go viral. People get very excited about it. And just that one, just part of the culture of it, you could say.
Those are such great stories. So I think the next levels that we'll talk about with the crowd equity and the crowd, so crowd investing and crowd lending. So whether you take an equity position or a debt position, those sound like they're a lot more serious a level and maybe a lot more regulated as well. So tell us what happened after the Oculus example. You said that some regulation came through.
Yeah, so equity crowdfunding has been very popular outside of North America for a long time. The UK dating back to 2010. Australia even had a platform running called ASOB, Australia Small Sale Offering Board, dating back to 2007. New Zealand has been around for well over a decade. And then even continental Europe, including but not limited to countries. Well, we had Israel, but it's also in Germany and other places, France, for example. All these places have a lot of equity crowdfunding. And then, but for some reason, Canada and the US, not so much. And so Oculus was one of the ones that sort of pushed things forward. And we had the Jobs Act, Jumpstart Our Business Act, that brought in a framework to allow equity crowdfunding in the US. And then the first offering started in May of 2016. That was the very first campaign was in May of 2016. And
my goodness. That's only 5 years ago. That's remarkable.
So it's not a long history. Yeah. So, and it's way behind the rest of the world. It's sort of funny because a lot of people think, well, hey, North America is the engine of entrepreneurship and innovation, but definitely somehow fell behind in this DeFi world that we find ourselves in, decentralized finance. And so but it's catching up and gaining in popularity. Basically the way it works is it's similar to an initial public offering on a stock exchange, but in the case of an IPO for initial public offering, when you list for the first time on, say, NASDAQ, the New York Stock Exchange, the Toronto Stock Exchange, you have to, for those cases, you have to put together a prospectus. Mm-hmm. Prospectus is that huge document that's often in really small font, single space, that it has all this mandated information, like 5 years of historical financial information, future-oriented financial information, all these risk disclosures, other things. And to put together a prospectus can be very expensive. It's normally in the hundreds of thousands of dollars, and then it could even be in the millions for a larger offering. You have to pay legal fees, investment banking fees, accounting fees. You have to pay people to go do due diligence. So for example, famous Canadian one was the Sino forest, so the, or as they say, see no forest, because someone didn't do their due diligence by actually going to see if there's actually a forest where this was based on, so the due diligence process, so very expensive to prepare a prospectus.
Might I also add with Canada, since we can also have offerings in Quebec, that then you also have the additional complication of having to have bilingual translation as well.
Exactly. And then, duplication of securities regulatory things, which they've tried to streamline over the years, but a lot of people think it's a bit of an antiquated system having, different securities regulators in each province. But that's a whole other conversation. So it's expensive to do an IPO. An equity crowdfunding offering is like an IPO without a prospectus, and the amounts raised. So the way things work in securities regulation is so anybody can raise money from a handful of people, but once you start you're trying to sell something like a share in a company, and you go out canvas a lot of people, then the securities authorities get worried that you're promoting something that shouldn't be promoted, or at least not promoted without a prospectus. And so then they have this general thing that you need a prospectus unless you fall within an exemption. And so there's different exemptions that get you out of having to prepare this expensive prospectus. And one exemption, for example, is if you're only talking to super rich people, like accredited investors that meet a wealth or income test, which varies by provinces over the years, as it turns out. But that's one type of exemption where you don't need a prospectus, because apparently the rich and wealthy people are sophisticated enough they don't need
that's interesting. That explains a
of the
lot.
legislation.
What is the typical approach that they take? Because the one I've seen, and this is again just relative to my home province, is I think you need to demonstrate that you've got 2 years of income above $200,000 or $5 million worth of net worth. And is that a fairly common bar to reach as to get as an accredited investor?
Yeah, but those levels have varied over time and across provinces. So, whether you're accredited in one province versus the other depends on the province. And so there's not perfect harmonization. It also varies across countries. So every country has their level of what an accredited investor is going to be. That they feel is appropriate for their particular jurisdiction.
Okay, so that's when you don't need to have a prospectus for investment. But then what is the level of access that you can be if you just want to be a regular investor? I mean, you talk about it being decentralized finance. So that suggests to me that there's a lot of retail customers who would want to, or retail investors who'd want to get, who would want to enter into this market. Is that what these platforms enable as a smaller investment?
Yeah, so the securities regulators created a new exemption in Canada called the crowdfunding exemption. And so the crowdfunding exemption is a new bucket that allows retail investors some access, not perfect access, or not unfettered access to crowdfunding. And so the crowdfunding exemption has in place on top of it a bunch of rules. And pre-June 2021, those rules varied by province, but since June 2021, they've tried to harmonize them. But they do have restrictions in there that include, for example, how much money a company or an entrepreneur can raise in a 12-month period. And that's now at $1.5 million after June of 2021. Previously, it was set at $250,000 for 2 capital raises. So $500,000 in a year. And now it's been up to $1.5 million. If you wanted a comparable statistic for the US, they pre-March of 2021, it was set at 1,070,000, and then they upped the limit to 5 million. So now entrepreneurs can raise up to 5 million through crowdfunding in the US. And then there's restrictions on how much entrepreneurs can, how much investors, like people like you and I, but they limit how much money that we can invest. So the limits in Canada previously per year were 1,500. So they limit basically saying if you want to lose some money, we're limiting you to losing 1,500, basically. Thinking of the downside, not the upside. And now it's been up to 2,500 is now the limit now. And then in other places, it's, other countries around the world, it's, different types of regulations, but perhaps a little bit similar. So in the UK, for example, the way they do it is 10% of your annual income is or total wealth, whichever is lower than that's the amount that you can put into an equity crowdfunding campaign each year.
Well, it's interesting too when you describe how different the limits are, and you can see, because you've done a paper where you examine the success in being able to raise money through these different means, and it looks to me, if I'm remembering the bar chart correctly, like the UK is way out ahead.
UK is the best crowdfunding market in the world. So the market works basically. So they've been around. They have the biggest platform is called Crowdcube. That's equity crowdfunding platform in the UK. I encourage you to, instead of watching TV tonight, just go onto the internet, look at Crowdcube, just because it's exciting. You see the innovations that are out there, that are being ideas that are being coming out, and then the UK market is one that works well. And earlier today we mentioned this idea of signaling, and one thing that you sometimes wonder about is does crowdfunding actually work, in the sense, do you see bad projects go ahead and get funded, or do you see others that are that should have been funded that aren't? And so what we like to look at in large sample evidence is you want to see if signals actually work in the crowdfunding case. And so we've examined a lot of data with the UK market, and you see that the market functions in a very efficient and proper sense insofar as when entrepreneurs design good campaigns and signal their ability, then they do very well. And so actually, I got a great, if you like examples, I got a great UK example.
Yes.
That a lot of people can relate to. It's at least at my time, it's now 4:00. And so, of course, what am I thinking about? Well, maybe I'm going to have a beer later today. So let's have a beer example. So there's this campaign in the UK dating back a few years back. Rushmore, they were raising money for bars, so pubs in the UK. And in just a short order, they raised over £1 million in a couple of weeks. They designed a campaign where they sold a 10% equity stake, and they only wanted to raise a few $100,000 or a few £100,000. They raised well in excess of that. I think the total capital raise was over £1 million. And so extremely successful equity crowdfunding campaign. And then, so a couple of months later, another bar comes along called, they didn't have a great name, called Meatballs. Well, maybe that's a good name, maybe not. But then they designed a bad campaign. And what I mean by a bad campaign? So same industry, same city. These are London-based bars. Same industry, same city. Meatballs comes along and says, we're going to sell a quarter of our company. And in their case, so the Rushmore, they wanted to raise £1 million. Meatballs only wanted to raise £300,000, and they said, we're willing to give up 25% of our company. And so the people that are familiar with the equity crowdfunding campaigns would go, that's ridiculous. Like, you don't want to give up 25% of your company. You don't need to give up 25% of your company. And in fact, if you say that you're going to give up 25% of your company, we might think that you're so stupid that you don't deserve to raise any money at all, right? And so indeed, and a month after starting this campaign, they only raised £4,700. So 4,700 pounds. That's it. And
That's remarkable.
So they didn't reach that threshold of so none of the money gets transferred to them, and that's what you would say is a properly functioning market where investors are not unintelligent. They can see what's going on, and if you don't design your campaign well, then you're not going to raise any money. And so many examples of this around the world where entrepreneurs try to raise money and they raise zero because they don't know what they're doing.
You're almost describing a market that is self-regulating in a way that's better than the oversight of a regulatory body.
Love it. Yeah, absolutely. Yeah. Of course, we're all worried that your grandmother or your dad or something is going to go, oh, well, I could put my life savings into this, but we don't see evidence of that happening, but indeed, I'm not saying there isn't a role for securities regulation here. Regulation is of course important to protect those downsides, and we haven't had so many or really any big major scandals, apart from the odd thing going on. But say relative to publicly traded companies, nothing pales in comparison. And so maybe something will come up in the future where we're going to say, oh, thank God we had some regulatory protection. But indeed, for the most part, we see this DeFi model where there's the wisdom of the crowd. It's a very properly functioning marketplace. But I would never go so far as to say there's no role for securities regulatory authorities. Because when people like to complain about them, but when we need them, we really need them. So thank God they're there. But indeed, that we do have to have that right balance of not having too much onerous regulation and the like. One of the ones that, if I can make a small point, or actually not so small point, is having audited financial statements. So that's one of the areas that many people have had concern about. So having audited financial statements is expensive. And so one of the regulatory concerns that has been in place over the years in Canada has been a requirement to have audited financial statements if you go the crowdfunding route. And people don't like that. That's too much of a financial burden on entrepreneurs to, commit at a very young and early stage to spending all that money on externally audited financial statements that could be problematic.
I have to presume that in the UK, since you said they have the best crowdfunding environment, do they not require audited financial statements?
Boy, it's funny that you asked that, and I'm pretty sure no, but I'm an academic. I always like to triple check when I look things up, and I wish I had that one to the top of my head. So
I'm going to go check it out.
I don't want to be online or say something that I'm not 1,000% sure on. So I'm always happy to admit when I forget something. So
no problem.
I'm not 100% sure on that one.
I should mention, if people want to look for a Canadian example, you looked this up for me earlier. Front Funder, FUNDR, is a place where they have the similar type of market, but it's really important for people to understand there's quite different approaches. And
Absolutely.
I think and the UK might be one that we should have a look at to see whether some of our rules need to be brought up to speed. You've given me a lot of confidence. I was worried about the state of entrepreneurship before I talked to you, because it does seem to me that there are a lot of forces against the capital formation and against investment and against entrepreneurs. But this gives me a lot of confidence that there is a grassroots level of support for innovation. Do you feel optimistic too?
I love it. Yeah, I get all animated when I think about crowdfunding. I think this is going to continue to grow, become increasingly important. It gives it really the best way to put it, democratizes access to capital in so many ways. So people that weren't traditionally fundable can become fundable, and so and it can be on many different levels as well. Like think of regional disparities. So being urban, rural, this province, that province. Traditionally, we've had gaps depending on where that centralized intermediary was. Now you have decentralized finance. It just opens the scope up there's so many tremendous new things. You could do this on a gender basis, male, female. There's even crowdfunding platforms strictly for women. Also, racial disparities would be another one. So when you have the crowd financing the population of entrepreneurs, then things become more fair, they become more open, equitable, and then you're not letting the decision about what are good ideas or bad ideas to perhaps the fewer individuals to think about it. You can get things going ahead based on what a greater sense of the population likes. So it's really a game changer, and it's something that I think we're only going to increasingly see, and there are very few reasons not to love it. I mean, I just think, boy, this is the most exciting thing that I've seen in ages, absolute ages. It makes me excited to get up in the morning.
It's remarkable to me that we still have so much upside since we're really so brand new at it. I'm looking forward to talking to you about this again once we've got a little bit more experience under our belt in North America.
Love it. Right on. Well,
thank you. That was Douglas Cumming. He is the DeSantis Distinguished Professor of Finance and Entrepreneurship at Florida Atlantic University, and of course, Senior Fellow with the Fraser Institute. We hope you enjoyed today's episode. If you like what you heard, be sure to subscribe on YouTube and wherever you stream your podcasts. And to stream old episodes, learn more about the show, and where to subscribe and submit your questions for future guests, visit fraserforum.org.